Welcome back to the Pro Ticker Podcast, your Thursday morning edition covering major financial magazine headlines, everyone. Wow. If you've been trying to keep up with the news over the last, 24 hours, it's just been an absolute flood.
It really has. Just
Okay.
nonstop information.
Yeah, we've got sources stacked up here from CNBC, Bloomberg, Yahoo Finance, and they're all pointing to this rare convergence, really. You've got major global stuff hitting all at once, a huge geopolitical summit, central bank decisions that seem, well, kind of fractured, actually.
Synchronized decisions, but not unified thinking behind them.
Exactly. And then these massive forward-looking spending plans from big tech. It's a lot.
It truly was a monster day. Usually you focus on one pillar, right?
Right.
Geopolitics or monetary policy or corporate strategy. But here we have all three landing basically simultaneously.
So our mission today in this deep dive is to try and quickly pull out the key insights.
Connect those dots for you, yeah, because it's dense, sometimes conflicting stuff. We want to explain what it might mean for, the bigger picture, your portfolio.
Okay, let's unpack this straight away. We have to start where the tension was highest, I think. South Korea. Let's dive into those details from CNBC, Bloomberg, and Yahoo Finance covering the Trump-Xi summit. The first reports out seem to point towards a truce. Practical, maybe, but precarious.
Precarious is definitely the right word. The most concrete thing, the immediate win, was just stopping things from getting worse, halting escalation. So China announced this one-year pause on expanding their export controls for rare earths and critical minerals. The new controls they just announced in October.
Right, the dramatic one.
Exactly. So that gives markets, 12 months of breathing room on that front.
But looking closely at the details there, that temporary halt, doesn't it feel a bit maybe cosmetic? Because the original controls, the ones from back in April, those are still firmly in place, right?
That's absolutely critical to understand, yeah. This relief, it only prevents a new crisis. It doesn't actually solve the existing one. So the truce is welcomed because, like I said, it stopped the slide towards a potential full supply chain shock. That's what analysts are calling a tactical pause.
A pause, got it.
And in return, the U.S. did make a tangible move. They cut those fentanyl-related tariffs on Chinese goods, dropped them from 20% down to 10%. That immediately lowers the total duty on Chinese imports from 57% down to 47%.
And China, what did they give on their side?
They immediately committed to resuming purchases of, and this is the quote, tremendous amounts of U.S. agricultural products, mostly soybeans, we assume.
Okay, soybeans back on the table.
Yeah. And beyond just the trade stuff, there were also some hints about maybe strengthening energy cooperation, something like an Alaskan oil and gas deal, but no specifics there.
Right, vague. But here's where the truce seemed to just break down completely. Big tech, decoupling. Everyone was watching the sources, waiting for any news on NVIDIA's advanced Blackwell chips.
Nothing. The leaders did not discuss approving sales for those specific chips.
Which is huge.
It is. Blackwell is, the absolute cutting edge for AI computing power right now. The status of those exports is really the litmus test for tech decoupling, the fact they weren't even on the table. It signals the tech war is still very much on, regardless of this trade thaw.
Instead, President Trump gave this unusual take. He clarified he sees himself as the arbitrator or the referee?
Yeah.
Between Beijing and NVIDIA on general chip access. That's a really interesting level of personal involvement in, high-stakes corporate strategy.
Definitely unusual framing.
Yeah.
And meanwhile, on TikTok, China's Commerce Ministry gave about the vaguest commitment possible.
What did they say?
Just that they'll work with the U.S. to properly resolve the divestiture issue. No details, no timeline, nothing concrete.
So that lack of specifics just reinforces what the analysts are saying, right? Those cited from Oxford Economics or the Asia Society Policy Institute.
Exactly. It all points back to this being a tactical pause, not some kind of strategic breakthrough.
Yeah.
The truce is valuable, yes, because it cooled things down immediately on the trade front. But the deep underlying structural problems, China's non-market practices, the whole push for supply chain security, they're still completely unresolved.
Right.
So this rare earths pause, it essentially just buys the U.S. and the G7 more time to actually execute on building those alternative non-China supply chains, which analysts think is structurally necessary anyway, whatever the political weather is.
Okay, so from geopolitical risk, let's shift to the risk setters themselves, the central banks. While the diplomats managed a temporary pause, the people setting the price of money seemed busy injecting a whole new kind of uncertainty.
That's a good way to put it.
We're shifting now, looking at reports from CNBC and Yahoo Finance on the Federal Reserve and the Bank of Japan.
Right, so the U.S. Fed, They delivered that expected 25 basis point cut. That brings the benchmark rate down to a range of 3.75% to 4%. The cut itself wasn't really a surprise. It was pretty much priced in. But the market reaction was all about Fed Chair Jerome Powell's language.
Yeah, he explicitly challenged that market idea, didn't he? The idea that the Fed was just on autopilot for more easing.
He did. That phrase, autopilot, was definitely the headline grabber.
Mm.
He stated very clearly that a December cut is, quote, not a foregone conclusion. Basically saying, look, with all this data uncertainty, especially with the government shutdown messing up the economic picture, the Fed needs flexibility more than it needs to make promises right now.
It really highlights how sensitive things are at the Fed, and the decision wasn't even unanimous, was it?
No, not at all. The reports show two notable dissents, actually. You had Stephen Barron wanting a bigger cut, half-point cut,
Okay.
and then Jeffrey Schmidt wanted no cut at all. He wanted to hold steady.
Wow. So that 3.75% to 4% range, it doesn't really reflect consensus then.
Not really. It feels less like a strong policy choice and more like maybe a political deadlock within the Fed itself. It just reinforces that feeling that the path forward is, well, anything but certain for them.
Okay, now let's jump across the Pacific. The Bank of Japan also made headlines, but they held steady.
That's right. They kept their benchmark rates at 0.5%. And that was a 7-2 split decision.
And the context there is pretty extreme, isn't it? Inflation's been over their 2% target for, what is it now?
41 straight months.
41 months. Wow.
Yeah. What's really fascinating here is the political layer. This is the first BOJ decision since the new prime minister, Sanai Takaichi, took office. And she's a known supporter of Abenomics, that extreme monetary easing, fiscal stimulus approach from the last decade. She's even previously called BOJ rate hikes stupid.
Right, so her being in charge now.
So despite that super high inflation, holding steady at just 0.5%, it feels like a political statement as much as an economic one, especially with the weak yen being such a major international issue. You even saw the U.S. Treasury Department kind of chime in, emphasizing the need for sound monetary policy to prevent too much exchange rate volatility.
Which sounds like a pretty clear nudge aimed at Tokyo.
A very clear, if diplomatic message, yes.
And just quickly, on the Eurozone, based on CNBC's flash data.
Yeah, the economy there just sort of eked out 0.2% growth in Q3. It did narrowly beat the 0.1% consensus expectation.
Okay, so slightly better than feared, but still pretty weak.
Exactly. That tiny beat is nice, I guess, but it doesn't really change the immediate outlook for the European Central Bank. Everyone pretty much expects them to keep their key deposit rate steady at 2%.
Because inflation ticked up again.
Yeah, inflation rebounded to 2.2% in September. So the ECB is walking this really thin tightrope. Unlike the U.S., which had some room to cut, the Eurozone is facing rising prices and minimal growth. So analysts are basically calling the ECB's next move a non-event, the rate-cutting cycle, likely over for them, at least for now.
Okay, let's pivot hard now to the corporate world, because this feels like where the money is making its biggest, boldest, maybe most certain bets.
That's a really interesting way to frame it, yeah.
We're looking at the CNBC and Yahoo Finance earnings coverage, the Magnificent Seven, and this just overwhelming theme of AI capital expenditure, CapEx.
Absolutely, the earnings results themselves. From Alphabet, Meta, Microsoft, mostly beat expectations, sure, but the number that really mattered, the one everyone was talking about, wasn't profit or revenue. It was the future CapEx commitment. Capital expenditure just completely stole the show. It's signaling this huge multi-year, maybe multi-trillion-dollar commitment to the whole AI infrastructure race.
Let's talk scale here, because this is the story, isn't it? Alphabet, Google. They raised their 2025 CapEx target. Again.
Yeah. For the second time this year. Yeah, now they're aiming for a range of $91 billion to $93 billion.
That number alone, it's more than the annual GDP of several countries.
It's staggering. But the real, corporate adrenaline shot was the projection for a significant increase in CapEx again in 2026. Driven, they say, by just trying to meet cloud customer demand. They apparently have a $155 billion backlog.
Just incredible. And Meta, pouring fuel on the same fire.
Pretty much. They lifted their 2025 CapEx guidance too, up to a $70 billion to $72 billion range. And when Meta's CEO, Mark Zuckerberg, was asked about all this spending, he actually defended it really strongly. He basically said it's better to invest too much than too little.
So the philosophy is, even if we overbuild slightly, it's not wasted.
That seems to be the argument. He argued that even if they end up with some excess AI computing capacity tomorrow, they can just repurpose it. use it to dramatically improve their core services, like the recommendation engines that drive their ads and feeds, which are super profitable.
Ah, okay. So the investment pays off over some period, as you put it, regardless.
That's the claim. And then Microsoft chimed in too, saying they expect their CapEx growth to actually accelerate in 2026 as well.
Wow.
So you have this collective doubling or maybe tripling down. It really suggests that any fears of some imminent AI bubble, like a repeat of the dot-com bust, those fears are being deferred. Because right now, the actual demand for this AI infrastructure is driving massive sales and huge backlogs. It feels real for now.
Okay, finally, let's close out our deep dive looking at where corporate strategy gets tangled up with political reality. We're looking at CNBC's report on a potential M&A deal, Comcast and Warner Bros. Discovery, or WBD.
Right. This is a really complex one. A potential full takeover of WBD, which, remember, has about a $53 billion market cap plus another $30 billion in debt. That size alone guarantees intense scrutiny from the Department of Justice. But the sources are really highlighting that the main roadblock here might not even be financial or antitrust in the traditional sense. It seems to be political and deeply personal.
Yeah, the reports confirm the elephant in the room, don't they? That really antagonistic relationship between President Trump and Comcast's CEO, Brian Roberts. Trump has publicly called Roberts some pretty harsh names. Lowlife, disgrace.
Yeah. And multiple analysts cited believe that a full acquisition would likely just get blocked by a Trump administration purely because of that personal antagonism.
Which, for the market, for anyone listening, it really shows how corporate strategy in the U.S. is now fundamentally tangled up with, and sometimes maybe even paralyzed by, individual political feuds.
That's the bigger takeaway for you, the listener, to track here. Now, interestingly, despite that very clear political risk, some Comcast executives reportedly think these concerns are maybe overblown or premature.
Optimistic.
Maybe. Yeah. But analysts aren't taking chances. They're already actively proposing these complex structural solutions just to try and get around the political hurdle tied specifically to Roberts.
What kind of solutions are they talking about? How do you avoid a political veto like that?
Well, one idea is divesting certain assets that are politically sensitive. The most obvious one being CNN, which Trump has criticized relentlessly.
Okay, carve out CNN. What else?
Another, more complex idea, proposed by Wolf Research, is something called a spin merge.
A spin merge. How does that work?
Basically, Comcast would spin off NBC Universal, its media arm, and then immediately merge that spun-off entity with WBD. The clever, or maybe cynical, part of this mechanism is that it would likely eliminate Brian Roberts' voting control over the new combined company.
Ah, so it's a structural workaround designed specifically to make the deal more palatable to regulators by sidelining Roberts.
Exactly. A really complex maneuver invented pretty much purely to try and bypass a personalized political objection. It's kind of staggering.
It really is a staggering demonstration of how regulatory risk has been reshaped by politics. Okay, so we've covered a massive day, a pragmatic but fragile truce in Asia, central banks cutting rates but shouting caution, and big tech placing these huge multi-year bets on AI infrastructure.
Yeah, and maybe the most profound contract today wasn't really in the details of trade tariffs or basis points. It was in the feeling of certainty itself. On one hand, you had the Federal Reserve suddenly insisting that all economic policy is now highly uncertain. Nothing is a foregone conclusion. Extreme caution.
Right.
And yet, at the exact same time, you had big tech operating with this entirely different level of confidence, committing to accelerate massive spending, billions and billions, well into 2026.
Total conviction versus total uncertainty.
Exactly. So you have to ask yourself, which vision of the future should you trust more right now? The confidence coming from corporate tech or the caution coming from the central banks? Which one guides your decisions?
A truly provocative question to think about this week. We'll see you all tomorrow morning with new headlines from major financial magazines.